right, we're back for the Beyond Wealth Advisors Economic Update. It's the month of May. I'm John Cleaver.
I'm Dennis Bacon, Chief Investment Officer, Beyond Wealth Advisors.
We're excited to be back. Last month, Kelly Manning stepped in and did a wonderful job. And boy, I'm not sure what happened to the market since last week or last month. But
I don't know. It's been a little crazy.
Here we are. Here we are. So just to kind of set the stage for this month's update, if you think about where we're at today versus where we're at a year ago, or where we were at a year ago, we're at roughly about the same, about the same place. We had a really nice run up the second half of 2021, and we've pretty much given it all back.
Right.
And then if we think about just the first week of May, which has been extremely volatile, we were up a lot, and then we were down a lot. At the end of the day, it all washed out, and it was about 0.25% difference towards the down, with the exception of technology.
Right.
The NASDAQ, the technology index, has been beaten up pretty good. Year to date, down roughly 24%. So, with all of that, where are we at in this crazy business cycle?
Well, it's kind of interesting. We expected volatility. We have talked about that many times.
Absolutely.
And one of the things that we're seeing right now, though, is we're finally seeing the service sectors open back up. We're seeing them open back up. They're starting to get some employees in, and that's good. But the labor market continued to be very tight. They're heavily tilted in favor of the person looking for a job, the job seekers.
Absolutely.
And never have we had this tight of a labor market. And we've also never had a recession when the labor market is strong. So that's a question that comes up to us a lot of, are we going to have a recession? I guess the answer is yes. I just don't know when. And it probably is not going to be this year, So that's the thing. The other thing that's happening right now in the business cycle is we're seeing the supply chain starting to normalize. Inventories are starting to build. And those are things that will help protect us from a slowdown, or more, rather, it'll help protect from more inflation, because the more inventories there are, the less pressure there is on supply chain.
Prices.
So the prices should start to moderate later this year, although we have a few more months of ultra high inflation.
Right, absolutely. Well, speaking of inflation, certainly there's been a lot of conversation recently about how to control inflation, which is impacting interest rates, and a lot of conversation about how quickly should interest rates be increased. We've seen an increase in interest rates just last week. And so talk a little bit about what do we expect the impact of the rising interest rates to have, and kind of where do you see that going?
Okay, well, currently the Federal Reserve, which sets the overnight interest rate, that's what the Federal Reserve rate is. It's for bank lending amongst each other overnight. And that has been near zero. We're a little bit short of 1% right now. And we do expect that to rise to somewhere around 3%. So another 2% rise over the course of the next year or so. Now, people will say, well, that's a problem. Well, actually, it's not.
Sure.
The ones who are going to really benefit that are from savers. People who have been having money in savings account getting 0.25%. A year from now, we may see rates of 3% or so.
Sure.
The other thing is the 10-year Treasury is now up to 3.2%. We would anticipate that may hit 4% by the end of the year. And that's also good for bond buyers who want to buy bonds and just kind of keep up with inflation, maybe get ahead of it a little bit. If we can get that 4.5% rate, we should be able to do that, and we can see that. So I think probably by the end of the year, people who want to buy bonds for a little bit of safety are going to be in a great position to do that. And so all the consumer interest rates, the big one is my daughter's buying a house. And so the interest rates currently on 30-year mortgage are around 5.25.
Right.
That actually is kind of normal.
Right.
It's actually on the low end of normal. So the biggest impact is for people who have just recently came into the home buying market over the past 10 years. They haven't seen these rates before. So a little bit of a psychological impact to them, but long term from an investment standpoint, it really doesn't present a problem. So we would anticipate once that's normalized and people kind of can see that as being normal, that is really not going to have a huge impact at this level. On the home building market, which we're woefully short in the number of homes we have available in America. We won't go into that today, but so that really portends good for the economy going forward.
Right. So that kind of maybe talks a little bit about the consumer, right? The individual, and maybe kind of what's going on in today's environment. Talk a little bit about, from a corporation perspective, and how does kind of the current landscape set up for corporations, and how do they kind of navigate their way through what we're experiencing right now?
Well, first off, the recent pullback in the market has really kind of normalized the pricing. We're at about a 19 price earnings ratio. It's still heavily tilted towards the technology side, though. It's still higher than what it historically has been, and the value side is still lower. So, but what we're also seeing in the corporation, we are expecting about an 8% increase in earnings year over year by the time we get to the end of this year, which is slightly higher than normal. We also know that corporations have more cash on their books than they have ever had in history, which is great if we have a recessionary environment at some point in time. It prepares them and sets them up for the safety factor of just having cash available. At points in time in the economy, cash is king, and that will be a situation for corporations down the road. So that's actually very encouraging on the long-term stability of our economy.
So if I hear you right, through the last couple of years, through the COVID process, corporations have actually positioned themselves very well for kind of what's to come.
Right.
And you often talk about the difference between the market and the economy. And it sounds like, in just hearing you talk today, that's really kind of where we're at.
Right.
And
so the market's been the big.
That's getting all the headlines.
All the headlines. Underlying, the economy looks pretty good. Now, I mean, one example of that is they're expecting dividends this year among corporations who pay dividends to rise by 8%. Right. Pretty healthy increase in the dividend rate.
Sure. All right, so cut to the chase. What's the bottom line?
Okay, we have a lot of headwinds. Didn't really talk about those a lot today. We've talked about those in the past. There are a lot of headwinds. There are a lot of potential black swans out there that cause a negative economic event. We can't control those. Those are the things that are uncontrollable. But what we can see is we feel like that the U.S. currently is well positioned to endure any type of downturn that we would see in the future, and that the current environment would say that everything really is improving. From a corporate standpoint and from a corporate profitability standpoint. And when you're investing in the market, you're buying into ownership of those corporations. We really see a lot of improvements from where we were at this point in time, and continue to see improvements. Not as robust as we saw a year ago, but we were coming from a really bad spot. So I feel very good about the economy going forward. I feel the markets are going to have some setbacks, and we're going to have a third year of recovery. Is always the most volatile year, and we are in that third year. And we've had a lot of days where the markets moved 1% up and down. And that's going to continue throughout the year.
Well, they often say, right, as corporate earnings go, corporate profits go, so goes the market. So I guess that's a positive thing to end today on. So, well, hey, we appreciate you tuning in again today. Probably now more than ever, this is a great opportunity just to have that conversation with your advisor and really sit down and make sure that your investment objective is in alignment with how you're positioned. Also look for those opportunities. Oftentimes when we hear negative news, or the market is maybe having some struggles, it is a great opportunity to prepare for what's to come, and that will be a strong recovery. So this is a great time just to kind of take inventory of where you're at, and then make some positive decisions going forward. So with that, again, we thank you for your time. We look forward to being back in the month of June. I can't believe that 2022 is nearing halfway over, but gosh, we're going to be there before we know it.
And summer's coming, right?
Summer's coming.
Go to the lake, have some fun.
All right, thank you.